Federal Reserve cut rates last week. We need to talk about why this is a big deal and what it means for your portfolio. Whenever the Fed cuts rates, it's like hitting the reset button on growth. Money becomes cheaper, risk appetites increase, and certain sectors of the market get a big boost. My name is Nick. I'm a former financial advisor. I'm the author of the Quick Start Guide to Investing.
Wow.
And at 42, I retired and I live off investments just like the ones I'm going to talk about today. This is an educational channel where I talk about what I am learning to keep me going back for my 9 to 5. This is not financial advice. If you want a financial advisor, go get one. If you want to learn about what I'm learning about, stick around. In this video, I'm going to share 5 stocks that could benefit massively after the rate cuts. Each of these plays into the AI semiconductor boom, but they benefit from Fed policies in different ways. Stick around to the end of the video because I will talk about which one I think has the best possible upside. In this short video, we're going to go over 1. What happens in the market when the Fed cuts rates? 2. How does this affect stocks differently? 3. What stocks I'm going to be buying because of this research. Welcome to 15-Minute Money, the show where I search the financial world for the most up-to-date investment ideas, market trends, and income streams so you don't have to. Let's get into it. What happens when the Fed cuts rates? Well, when the Fed cuts or lowers interest rates, borrowing costs drop all across the economy. And that means companies can finance expansion more easily, investors shift into riskier assets like stocks, and growth sectors like tech usually outperform. Historically, markets tend to rally 12 months after the rate cuts, especially, just like right now, if the cuts are happening around all-time highs and the economy is not in a recession. And that is the case right now. We're 2 for 2. Markets are clearly near all-time highs, and as far as the government's telling us, we're not in a recession. Now let's put the cherry on the top. When the Fed makes rate cuts slowly, like we see now, again, they haven't cut since last year, they're in no hurry. And this tells the market, chill out. However, when they cut quick, that signals bad things for the economy and the market panics. Look at this chart. When the Fed cuts slowly, remember the last cut was last year, the market actually performs really well in the long term. Short term, you can see that there was some negative volatility in the 1 month and the 3 months, but after 1 year, you only see one red year. That was 2001. So that could be good for patient investors who want to buy a potential pullback if you see a dip over the next 1 to 3 months. But you have to remember, not all stocks are going to benefit equally. Growth companies that rely on capital investments, like semiconductors, AI infrastructure, and data centers, are usually some of the biggest winners. And that is exactly why the 5 stocks I'm going to cover are interesting right now. First up, Nvidia. Ticker symbol NVDA. No surprises here, obviously. Nvidia is the heart of the AI revolution. The GPUs are the backbone of training and inference for large language models, and demand has been off the charts. They can't even make things fast enough. Rate cuts are good for Nvidia because 1, they make it easier for hyperscalers like Microsoft and Amazon and Google to finance data center expansion. 2, lower yields usually boost tech valuations, which benefits mega cap companies like Nvidia big time. Now, Nvidia is not cheap by any means, but in a falling rate environment, high growth companies often get a valuation premium. Think of it less as overvalued and more of like the price of leadership. With 43 of 48 analysts saying Nvidia is a buy or a strong buy right now, it's a good time to look at Nvidia. The 12-month price target is $181. In long-term forecasts, reaching $265, even $1,000 for the most optimistic analysts. Earnings per share of Q2 was $1.08, which beat estimates. And you've got a trailing 12-month EPS at $3.54. They're profitable, they're growing, and everybody wants their product. You have to pay more for the world's best companies, and Nvidia has proven time and time again they are the best. Next up is Coreweave. If you're not familiar, Coreweave is a cloud infrastructure company specializing in GPU-accelerated workloads. That's a mouthful. I know, let's break it down. They are one of Nvidia's biggest customers and partners, and they build cloud platforms optimized for AI. The reason Coreweave is exciting after rate cuts is because their business is capital intensive. They need to borrow to build data centers, they need to expand server capacity, and they need to lock in GPUs. Lower rates make that expansion cheaper and faster. Coreweave has demonstrated massive top-line expansion with trailing 12-month revenue at $3.5 billion. And year-over-year quarterly sales growth of 542%. This obviously reflects surging demand for AI-focused cloud services, and when you've got major clients like OpenAI and Microsoft backing you, it's a good bet. Third, you've got Taiwan Semiconductor, ticker symbol TSM. Some people say TSMC, some people say TSM. Let's not get into the weeds. Let's stick with TSM because that's easier for me to say. And stupid is as stupid does. TSMC is the world's leading chip foundry. They're producing the most advanced semiconductors for Nvidia, for Apple, for AMD, and more. Here's why rate cuts matter for TSM. They're building fabs. It's insanely expensive. TSM's customers, whether it's Nvidia or Apple, will be in a stronger position to ramp up orders as customer conditions loosen. TSM is a true monopoly in the space. It's one of the strongest economic moats, and its valuation is priced way more than most tech companies. It is by far the world's most dedicated, largest semiconductor foundry. They've got, I think it's like 60% of the overall market share. On top of that, global demand for chips tends to follow cycles of economic expansion. So rate cuts are meant to stimulate growth, which usually means stronger semiconductor demand. TSM is essentially a toll booth on the chip economy. If AI and tech spending accelerate, they collect fees at every single booth. TSM expects a 30% revenue growth in 2025, forecasted revenue of $31 to $33 billion, implying a 30% year-over-year growth. Fourth, let's talk about Intel, INTC. This is a company that I kind of love to hate. A few weeks ago, I would have said, Intel? Are you serious? The stock is a total loser. However, that was before the US government bought 10% of them, which I don't necessarily agree with, but it happened. And then last week, Nvidia bought another 4 or 5%. Nvidia's CEO described it as an incredible investment with fantastic returns, emphasizing its role in focusing Nvidia's AI stack with Intel's x86 ecosystem. Intel will design and manufacture NVIDIA custom x86 CPUs, and they will be integrated automatically into NVIDIA's AI platforms via their NVLink. So this is a lot of mumbo jumbo, but it's very important. Basically, you've got the king of GPUs, NVIDIA, saying that we are going to allow other companies to use our scaling system, and then they bought into one of their competitors. Now they're CPU partners. So for hyperscaling and enterprise workloads, this is important. The tight coupling addresses NVIDIA's need for optimized CPU and GPU fusion in their data centers, where AI infrastructure is projected to reach $3 to $4 trillion by the year 2030. Intel is in the middle of a massive turnaround, investing tens of billions into new fabs into the US and in Europe, and with rate cuts, financing these builds becomes less costly. That improves their runway to compete with TSM and eventually, hopefully, for their case, play a bigger role in AI. Intel could be an interesting value play, if there is such a thing, on the rising tide of AI. As rising tides go up, it even brings the little boats like Intel. Finally, let's talk about Vertiv, ticker symbol VRT. It's the global leader in critical digital infrastructure. They provide cooling and IT management solutions essential for data centers, communication, networks, and industrial environments. They can do all sorts of things. The AI workloads generate enormous amounts of heat, and Vertiv has become the crucial partner for hyperscalers expanding their infrastructure. Rate cuts help here because cheaper financing means more data center construction, and every new rack of GPUs needs new cooling and power management. Analysts forecast 25% sales growth in 2025, slowing to 16% in 2026. But with no slowdown in hyperscaling or CapEx spending, I think they're set very well. Earnings are projected to rise 34% this year. Vertiv has been one of the under-radar beneficiaries of AI demand, but as rate cuts drive more capital into infrastructure, their growth runway could be huge. So let's recap. Nvidia is the king of GPUs and the pure AI growth play. Coreweave is a high-risk, high-reward AI cloud bet. TSM is the indisputable chip manufacturer. Intel is the turnaround value play, if there's such a thing. And then Vertiv is the infrastructure backbone, cooling all of these data centers. If I had to rank them on a risk-to-reward scale, I would say Nvidia and TSM are probably safer. They're more proven leaders. You've got Coreweave as kind of like the speculative ship, but I like it. I own it. Intel is the contrarian value play because they were left for dead until a few weeks ago. And then Vertiv, it sits kind of right in the middle. It's leveraging AI demand without necessarily being a direct chip maker. So that's my list of 5 stocks to watch after the Fed rate cuts. Which one do you think has the biggest upside? Drop a comment below. I'd love to hear your take. And if you got value from this breakdown, don't forget to hit the like and subscribe. Every single week, I put out videos like this to keep me from going back to my 9 to 5. I'd love to see you here. Thanks for joining me today on 15-Minute Money, the show where I search the financial world for the most up-to-date investment ideas, market trends, and income streams so you don't have to. I'm your host, Nick Bradley. We'll see you next week.